Every empire believes it's building forever, until it realizes it's been mortgaging the future to fund the illusion of today. In 1929, that illusion was called the New Era. Wall Street believed radio stocks would transform civilization, that prosperity had become permanent, and that every working American could now get rich from their living room. By October, 12 million investors had borrowed money they didn't have to buy stocks they didn't understand. Then the floor dropped. Within 3 years, 25% of Americans were unemployed. Banks vanished overnight. Millionaires became paupers. And the architects of the boom, they blamed everyone but themselves. In 2008, the illusion had a different name, the housing miracle. Bankers called it financial innovation. Regulators called it progress. Homeowners called it the American dream. They were all wrong. It was the same con, rebranded for a new generation. By the time Lehman Brothers collapsed, 9 million families had lost their homes. Wall Street executives kept their bonuses. And the public? They were told it was their fault for borrowing too much. The system that created the fraud got a bailout. The people who trusted the system got nothing. And now, in 2025, we've arrived at something far more dangerous. Something Wall Street whispers about in private, but denies in public. It's not just tech stocks this time. It's not just housing. It's everything. Stocks are up 25% this year. Gold has surged 55%. Bitcoin just hit $123,000. Real estate prices remain near all-time highs despite mortgage rates at 7%. Every asset class, every single one, is screaming confidence. And when everything rises together, history has a word for that. Bubble, or more specifically, the everything bubble. The moment when every price becomes a lie and the whole system begins to collapse under the weight of its own delusion. Welcome to the greatest financial illusion in modern history. And if you think it ends differently this time, you haven't been paying attention. In October 2025, Wall Street isn't worried. They're celebrating. The S&P 500 is riding a 7-day winning streak. Tech giants like Nvidia, Apple, Microsoft, and Meta have pushed valuations into the stratosphere, together worth more than the GDP of Germany, India, and Japan combined. Gold just broke $4,049 per ounce, hitting 39 new records this year. Bitcoin's on a tear. Real estate refuses to correct despite mortgage rates that should be crushing demand. And yet, none of this is raising alarms. Mainstream economists insist it's not a bubble, just new fundamentals. They said the same thing in 1929 when investors borrowed billions to buy radio stocks. They said it in 1999 during the dot-com mania. They repeated it in 2007 when housing prices never go down. But here's the problem. This time it's not just one sector that's inflated. It's all of them. Morgan Stanley calls it the age of correlated illusions. When money itself is broken, everything priced in money becomes broken too. Central banks have spent the last 15 years printing trillions, suppressing interest rates, and inflating asset prices far beyond any connection to reality. The Federal Reserve alone expanded its balance sheet from $800 billion in 2008 to over $7 trillion by 2022. And now, despite inflation still hovering around 3%, they're cutting rates again. Why? Because the system can't survive without cheap money. The moment rates rise, the illusion shatters. And that's exactly what happened before, every single time. In 1929, the bubble was margin debt and radio stocks. Aussie A, the Nvidia of its era, soared from $85 to $549 in 2 years. It had no profits. Just promise, just hype. Investors didn't care. They borrowed 90 cents on every dollar to buy more. Banks encouraged it. Regulators ignored it. And when the crash came, it wiped out $30 billion in wealth equivalent to $500 billion today. The Dow fell 89% over 3 years. But here's what they don't teach you in school. The crash didn't happen because the economy was weak. It happened because the economy was fake, built on borrowed money, inflated promises, and the belief that markets only go up. Sound familiar? Fast forward to the 1970s. The illusion this time was that governments could print prosperity without consequences. Nixon ended the gold standard in 1971, unleashing an era of pure fiat currency. For the first time in history, the dollar was backed by nothing but trust, and that trust evaporated fast. Inflation exploded to 14%. Oil prices quadrupled. Gold surged from $35 to $850 an ounce as investors fled paper money. The stock market collapsed alongside the dollar, losing 45% of its value in real terms. But Wall Street kept insisting everything was fine, until it wasn't. Then came 2008, the housing bubble, subprime mortgages, credit default swaps, the illusion that real estate prices never fall. Banks packaged garbage loans into rated securities. Regulators called it innovation. Rating agencies rubber-stamped the fraud. And when it all collapsed, 15 million Americans lost their jobs, 9 million lost their homes, and the global economy lost $22 trillion. But the architects of the disaster? They got bailouts. Goldman Sachs alone received $10 billion in taxpayer money. Eight executives collected $165 million in bonuses 3 months after the collapse. Meanwhile, ordinary families were told to tighten their belts. Every crash follows the same script. First, disconnect from fundamentals. Then, faith in a new paradigm. Next, the government reassurance that this time is different. Finally, public shock when reality returns. And always, financial amnesia. Within a decade, the cycle repeats. And here we are, again, October 2025. Every metric is screaming bubble. And every expert insists it's fine. Here's what they're not telling you. In a healthy economy, some assets rise while others fall. Risk moves between sectors. Capital flows to opportunity. But when stocks and gold and crypto and real estate all surge together, that's not confidence. That's fear disguised as optimism. It's investors hedging against every possible collapse, because deep down, they know something's broken. Gold hit $4,049 per ounce this year, its 39th record high. Central banks are stockpiling it like doomsday preppers. China, Russia, Poland, Turkey all buying gold at record pace. Why? Because even governments don't trust the system anymore. Meanwhile, tech stocks have become more concentrated than at any point in history. The Magnificent Seven, Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, Tesla, now represent 35% of the entire S&P 500. That's more concentrated than the market was before the 2000 dot-com crash. Nvidia alone has a market cap larger than the entire economy of Canada. It burns through $1 billion a month. Investors call it genius. History calls it insanity. And the warning signs are everywhere. The Warren Buffett indicator, the total value of the stock market divided by GDP, just hit 218%, the highest in recorded history. Before the 2000 crash, it was 140%. Before 2008, it was 105%. Even Warren Buffett himself once said that when this indicator reaches 200%, you're playing with fire. Well, we're past that now, and nobody's putting out the flames. Bank of America recently surveyed institutional investors. 54% said the market is overpriced. But here's the twist, they're still buying, because in a bubble, doubt becomes unpatriotic. When everyone's portfolio depends on belief, questioning the narrative feels like betrayal. So they keep buying, keep borrowing, keep pretending, until the music stops. But what causes the music to stop? Not panic. Truth. Truth in the form of numbers that don't lie. Truth in the form of debt that can't be repaid. Truth in the form of leverage that collapses under its own weight. The 2025 everything bubble isn't an accident. It's engineered, designed by central banks that have spent 15 years extending easy liquidity to avoid any deflationary reset. That means asset prices now require inflation to survive. It's not growth, it's addiction. Nvidia, Apple, Bitcoin, gold, housing all inflated by the same drug, cheap debt. And here's the mechanism. When the Federal Reserve cuts rates, it doesn't just make borrowing cheaper. It forces capital out of safe assets like bonds and into riskier markets. Pension funds, insurance companies, sovereign wealth funds, they all chase yield wherever they can find it. That pushes up stock prices, real estate prices, gold prices, and crypto prices. Everything rises together, not because the economy is strong, but because money itself has become worthless. And when money is worthless, prices become meaningless. GIS reports warns that valuations have decoupled so far from earnings that entire asset classes now function as self-referential mirages. The price of money detached from reality is now measured in confidence, not productivity. We no longer invest for growth. We speculate on belief. And belief, like a bubble, only expands until the pin arrives. So what's the pin? It could be tariffs that disrupt global trade. It could be a liquidity crisis, a geopolitical shock, a Federal Reserve mistake, or it could just be math. When assets are valued at multiples of GDP, collapse becomes inevitable. Gravity doesn't care about optimism. And right now, the Shiller-Cape ratio, a measure of stock valuations adjusted for inflation, sits at its third highest level in history. The only times it was higher? Right before the 2000 dot-com crash and right before the 2021 meltdown. Even ChatGPT, an AI language model trained on financial data, acknowledged in October 2025 that we're in an AI bubble. Let that sink in. The technology driving the bubble is warning us about the bubble, and we're still not listening. Here's what happens when everything crashes. The illusion of wealth evaporates, but the hierarchy behind it doesn't. Those closest to capital creation, banks, governments, insiders, redefine the rules. In 1933, Roosevelt devalued the dollar and confiscated private gold. In 1971, Nixon abandoned the gold standard entirely. In 2008, the Fed invented quantitative easing, printing trillions to bail out the system that caused the collapse. And what comes after 2025? Probably worse. Central bank digital currencies, programmable money, socialized speculation under a new name, financial stability. The house always wins, especially when it prints the chips. Thomas Jefferson once warned that banking institutions are more dangerous than standing armies. He didn't foresee credit default swaps or IETFs, but he understood the pattern. When governments control credit, credit controls citizens. The everything bubble is not just a market event. It's the final stage of trust decay. From asset bubbles to cultural bubbles, belief is collapsing faster than supply. And here's the darkest part. Empires don't fall when they go broke. They fall when they pretend not to. Rome debased its currency for centuries before its collapse. Weimar Germany printed money until it became wallpaper. Argentina defaulted 9 times. Each time the elites insisted it was different. Each time the people paid the price. The last time every asset rose together was 1929. Faith died in a single week. This time it might take longer. But the math is already written. If you're still watching, you already see it. The cracks in the foundation. The experts who can't explain why everything keeps rising. The feeling in your gut that something's wrong. Trust that feeling. Because when the crash comes, they'll call it unexpected. They'll blame external shocks. They'll say no one could have seen it coming, but you did. And if you remember nothing else, remember this: the system isn't broken. It's working exactly as designed, to transfer wealth upward, to protect the powerful, to leave you holding the bag. Knowledge won't fix the system, but it protects you from it. Stay skeptical, because the future always begins with a forgotten past. Subscribe to Money's Hidden History, not because it helps the algorithm, but because the truth doesn't stay visible without people like you keeping it alive. This is history repeating, and you're watching it happen in real time.